Good afternoon, everyone. How are we doing? Excellent. I've actually been to the ACC events for the last 2 years. Well, this is the third year. The first time was in 2022. It was a month before FTX. So we were pretty much at max bearishness. Last year, things were bullish. Things were definitely picking up. But there was still a lot of cautiousness and, cautious optimism, I would say. This year is completely different. So it's almost like we've gone through, 3 of the seasons of crypto in the last 3 years. And here we are, Bitcoin nearly 100,000. Now, today's presentation is a little bit of a, obviously it's going to be about AI and blockchain, but it's really a discussion about some of the major challenges that we face as a world, as a global financial system. But before we go into it, I'm actually going to give you just a little bit of background about myself. My name is Jamie Coutts. I am the Chief Crypto Analyst at Real Vision. Perhaps I can just ask the audience here, how many people have heard of Real Vision? Wow, that's phenomenal. I wasn't actually expecting it to be that much. Next question was going to be if that number was low, who here has heard of Raoul Pal? But the same number of hands would go up, obviously. So just a little bit about the platform that you may not be aware. Hopefully a lot of you are subscribers. We are a financial resource and platform, started in 2014. Raoul has a background in macro research, macro trading. He was an investor, and he built a platform which was really about bringing truth to finance. And I joined about a year ago to head up the crypto research division. And so there's a lot of content now on the platform which is really dedicated to do deep dive research into this emerging asset class. And my mission, personally, is to democratize institutional grade research for the masses, for the public. And so you might want to check out Real Vision's platform for all the new content there that we have on the platform. Now, today's talk, as I said, it's obviously the title gives it away. But before we sort of get into the technological changes that are happening, we sort of have to understand what's actually happening at a sort of a macroeconomic level and some of the challenges that we face. And obviously how the technology of blockchain and AI can hopefully address some of the systemic problems that we face. Now, the global economic order, for those of you who've been paying attention, is fracturing at the seams. So while we've seen extraordinary innovation over the last 30, 40 years and longer, what we haven't seen really is we haven't seen really sort of an improvement in the purchasing power, or we haven't seen great improvements in terms of productivity. Now, the question that we should all wonder, what is the end state of the current financial system or the current trajectory that we're on? I mean, what typically happens when you get excessive debt growth married with economic growth that is either stagnant or declining? What happens when you get growing what happens when you get growing amount of debt and you don't have productivity gains to fuel that GDP growth? And then once again, what happens when you have ballooning debt growth and you have a slowing population? So these are obviously not hypotheticals. This is the situation that we find ourselves in today. Global debt now exceeds over $300 trillion. That's 350% of global GDP. And it seems that the central authorities, the central planners, the governments, the central banks, the corporations that have grown up around the financial system don't have any answers to the problems that we face. Now, this is where the opportunity lies. You've got now 2 very transformative technologies, and that's really an understatement. AI and blockchain are going to radically change the world that we live in. And they're going to provide immense opportunities for us as individuals. But they also have the ability to completely transform and address the major structural problems that the world faces. And so today's presentation is going to go through the problem. So what exactly is broken and why? We're going to talk about the solutions. I've mentioned them already. We're going to go in a little bit more detail. And there's a third pillar to this solution, not just blockchain AI, but Bitcoin is an integral part of how we dig our way out of the current malaise. And then thirdly, the opportunity. We need to understand where the opportunities lie and how we should position for the future. And so hopefully at the end of this presentation, we'll walk away from knowing exactly, what are the problems, what are the challenges, and take the actions necessary to hopefully make the most of the opportunities that lay ahead. So simply put, what's the problem? We don't have enough growth, we have way too much debt. Now, this chart here, if you're seeing this chart for the first time, you might be a little bit surprised, because when you juxtapose this chart, which is showing global growth cumulatively and the rate of change, so the cumulative growth is the chart there in green, and then the growth rate is in red. Who here has heard for the past 20 years, 30 years by people at the WEF, the UN, Bill Gates, that there are too many humans on the planet? There's too many of us. We need less of us. Well, actually, the reality is that we are now looking at a population cliff. For the first time in human history, population is set to decline across the world in about 50 years' time. What actually has happened is that the growth rate of the population peaked in 1960. And ever since then, the growth rate has been coming down. Now, until I saw this chart a couple of years ago, I never would have believed it. I've been told that, we should have this scarcity mindset. Too many humans. We're destroying the planet. I would argue that is not the case. There is not enough humans, especially when you look at the economic system that we have. And also, if you take a little bit of a different mindset than the scarcity one and look at the abundance factor. And thankfully, we've got people like Elon Musk who really understands this and is pushing it forward. The point is that not even after World War I, World War II, not even after the bubonic plague in Europe, where 30 to 50% of Europe was supposedly wiped out, has there ever been a decline in the human population. Now, bringing it back to sort of an economic sense here, fewer workers means less economic output, plain and simple. And there's no amount of debt or policy can essentially fix that reality. Now, over the past 30 years, as I've said, we've had all these innovations. We've seen the rise of the PC, the internet, we've seen cloud computing, mobile, all these fantastic things that have made our lives better in many, many ways. But here's the paradox. Global productivity has actually stalled. It hasn't budged for 20 or 30 years. Now, you have to ask yourself the question of why. We've seen massive technological improvements, but productivity hasn't moved. And I would argue that it is because we have almost ingrained, we have automated the most efficient things into the global system, namely finance or the financial system, which is archaic. And that is holding global productivity back. So when you look at this data and you realize that, at least on the surface, we've seen massive improvements in our life, productivity is actually declining or has been stagnant. And that means economic growth is stagnant, because I've just explained two of the three pillars which drive GDP growth. We have slowing population growth, soon to be declining population growth, first time ever, completely unprecedented. And we've got productivity that has gone nowhere despite massive changes in technology. The third piece of the puzzle is the exploding debt. The debt is exploding because growth is declining. Now, on the left-hand side, you can see the growth in global debt. It might be a little bit, you can see it pretty clearly, but the yellow part of that chart is government debt. Government debt is growing faster than private debt and commercial debt. Now, when you look at the two major superpowers, the United States and China, you have a problem. And you can see it in the table. Debt growth is faster than GDP growth. This means that the government debt to GDP ratios are skyrocketing. Now, this is why it matters. Economists, for what they're worth, would say above 120% is when you get a tipping point, because that's the point where a government budget, where the national budget starts to be dedicated more to paying back the interest on debt when it gets that high than it is on actually basic services or investing in the country for the future. So when you have debt to GDP at the levels that we have in the two main economic superpowers, there's no other country that comes close to these two, then you're typically in a situation where both of those economies, and thereby the global economy, is very susceptible to shocks. It's extremely vulnerable. It's typically where you see major devaluations in currency. It's where you typically start to see social unrest, and from there, these things can escalate into kinetic wars. So all of this was leading up just to show you a very simple equation for how you work out GDP growth. And you can see on the chart here, population, productivity, and debt are all moving in the wrong direction. And as I said, typically the outcome from this is bad things: wars, civil unrest. Now, you've got to ask yourself, do the central planners know this is happening? And of course they do. They understand it better than anyone. Do they have the answers? Do they have the solutions? No, they do not. And that's because they don't have the tools. They see the world through their dogmatic lens of monetary policy. So every single time there is a crisis, when growth slows, when the risk of defaults or bankruptcy, they will print more money because they can. They have the power of the printing press. Now, on face value, that seems fine. That gets us through from crisis to crisis. But essentially what that's doing, it's creating inflation. It's creating monetary inflation. When you print more currency units, it drives up the prices of assets, and ultimately it will drive up the price of goods and services. We are paying the price for what happened just 2 or 3 years ago when they shut down the economy and said, we'll just print the money instead. And so now we are experiencing very high price inflation for the first time, as well as asset inflation. Now, this just perpetuates it's a vicious cycle that perpetuates what is essentially a fundamentally broken system. Now, expecting these people to fix it is the equivalent of asking the arsonist to take charge of the fire department. They don't have the tools. Bringing it back just to sort of ram the point home, this may seem or feel, ephemeral or conceptual. This chart tells you exactly what is going on, so I'm going to break it down. How does it actually affect you and I as maybe a standard wage earner? Well, while over the last 15 years they've printed money at a rate, an unprecedented rate, the Federal Reserve, and believe me, I could have swapped out US data here and put in Australian data. In many ways, it's actually worse. The money printing by the Federal Reserve has been around about 9%, and the increase in the money supply in the US has been around 6.5% year on year for the last 15 years. Real wages are up 60 basis points. But that is a lie. It's actually negative, because the way you calculate real wages is you take the increase in wages over time and you deduct the inflation rate. What's the inflation rate? It's CPI. It's this government number they feed us to tell us what the inflation rate is in the economy. If I did a survey, I'm pretty sure that everyone here would agree that in Australia, the inflation rate has not been 5%. In most cases, it's been well above 10%. So really what we're looking at is negative real wage growth. But they printed all this money. So who's benefiting from this? If our wages aren't going up and they've printed all this money, where is it going? And that, ladies and gentlemen, is the game. Because what this does is it feeds certain vested interest groups or people that are essentially very close to the money printer. Now, here in Australia, we have a love affair with property. So when you look at asset prices, because if people appreciate the fact that their wages are not keeping up or their purchasing power of their wages is declining, then they might look at their superannuation fund or they might look at their property portfolio and think, I'm cool. I can probably take that hit but my assets are going to go up. And yes, indeed they have. We have asset inflation like we've never seen before. But when you compare asset inflation in real terms, so what does that mean? You actually look at it adjusted for the increase in the money supply. This chart here tells you that at least capital city property over the last 10 to 12 years has barely kept up with the increase in the money supply. Now, you know, I'm being a little bit outrageous there because you can lever up property, right, several times, and so therefore you are actually beating the increase in money supply because you're borrowing to do it, and it makes sense to do it. That is one way to offset the monetary inflation. But think about it. This is breeding inequality. If you already have the assets, you're fine in a relative sense. You are still losing because you are being debased. You're just not being debased as much as other people. Who are those other people? They are lower and middle income earners, young workers who are entering the workforce who have got negative wage growth because of the money printing, plus they can't even buy the property that you may have in spades. So that's fine for a while, but believe me, that doesn't end well for any society. So to say the system is broken is probably an understatement. It's basically rigged to the asset owners. And the governments will continue to rack up the debt because they have control over the money printer and create the inflation that affects all of us in our daily lives. So we need a brand new growth paradigm, ladies and gentlemen. And the reality is that we can't expect it to be fixed from within. Okay, the vested interests, the institutions that have grown up around the money printer will not let go of the control that it gives them. So the central bankers, they don't have the tools to actually fix it in any case. The answer lies in technology. The answer lies in bold solutions that can fundamentally change how we approach productivity, value, and monetary stability. So let's just explore what I mean by this. If you look at that formula that I showed a little bit earlier, where everything was moving in the wrong direction, I think we're about to see a brand new growth paradigm. So despite laying out a fairly pessimistic view of what's happening, I am extremely optimistic. And for us as individuals, this is the information that hopefully will equip you to sort of move forward in this new paradigm and potentially make as much money as you possibly can. Because I think population's going to change. AI is already here. AI agents are already here. They just haven't proliferated. We're at the very, very start of an exponential adoption curve or growth curve in AI agents. But the new population, sadly, won't be humans. It will be AI agents. And this, essentially, is an infinite workforce. And it's also an infinite source of consumer demand. Blockchain fits into this because blockchain is a productivity engine. It's been held back by governments and regulators, but is about to be unleashed thanks to a new mindset in the US. And that will trickle down to Australia, who unfortunately doesn't like to lead or be innovative. They like to follow, but it will come here as well. Now, once you get the intersection of AI agents using blockchain rails, we're going to see a productivity miracle, the likes of which we have never seen before. Now, the third part is just as important as the first two. Because if you don't get the third part right, the governments can still debase us. They can still print and destroy our purchasing power. And so the adoption of a Bitcoin standard, not as individuals, because I would hazard a guess and say that most of us are on some kind of Bitcoin standard right now, but governments will also have to move to a Bitcoin standard as well. And this will be the elements that will create a new engine of growth. So this is just, to go into a little bit more detail about AI. It should redefine really what population actually means. AI agents are tireless workers 24/7. They don't ask for pay except for the cost of electricity. And they will scale across industries which, quite frankly, at the moment, are not moving with the pace of technology. Those industries, for me, clearly are finance, education, and healthcare. These industries are growing, I might also say energy as well. Sadly, in Australia, we have abundant energy. Energy costs are going up because we have a totally batshit energy policy. And while energy should be falling to the marginal cost, or falling or collapsing to zero, in Australia it's going in the opposite direction. This will all get solved eventually. But these industries have a chokehold on our economy, and once we actually unleash the productivity engines of blockchain and also AI, we should see massive cost reductions, and that is going to drive a lot of economic growth. Now, I call blockchain the productivity substrate. It is the layer upon which AI will be empowered to do the wonderful things that we think it will be able to do in the very, very near future. So forget, as much as anyone here might be a crypto degen, trading meme coins, or if you're coming into the space for the first time and that's kind of all you hear, that's fun, but that's really a distraction from what's happening. We are seeing a revolution in finance. Blockchains are replacing legacy financial rails. If you're a new fintech today, and we just heard from Drew Bradford at CloudTech, who's actually driving the first Australian stablecoin project. If you're a new fintech, you're on blockchain rails, you're using stablecoins. If you're an old fintech, like when I say old, maybe you've started in the last 10 years, you're swapping out the banking rails for blockchain rails and using stablecoins. So this will unlock trillions of dollars in costs that we all pay in slow settlement or high fees when we do cross-border settlements. We can't do micropayments because it's just not even feasible on traditional rails. And this is going to obviously drive productivity and economic growth. The chart, I'll just mention this chart on the right. The one on the left just shows you stablecoin adoption. That blue line that starts at the very bottom and goes up in a very steep gradient, that's stablecoin adoption. It's already taken over PayPal. It's taken over global remittances in terms of how much value is moved using blockchain rails. It's only been around for 8 years. Next is Visa, and then we're on to Fedwire and ACH, the big payment systems in North America and also Europe. So the graph on the right is actually a report done by the IMF of all people. And in that report, they said that DeFi has the ability to strip out trillions of dollars in costs, and a DeFi protocol can essentially do what a bank does for anywhere between 60 to 70 to 80% cheaper. We also had a Fed governor just 1 month ago do a presentation on DeFi and why it's complementary to the traditional financial system. So it's all changing. Now, as I said, this will all change our lives, but it won't matter unless we get the money system right. And what we've seen in the last 10 years or plus since Bitcoin came along is that people have decided to store their wealth in this trustless, uncensorable, immutable network rather than in traditional assets. Now, whilst it started as a tool for financial sovereignty for individuals, it is moving up the financial stack. Corporations, wealth managers, pensions, and we are now at the cusps of nation states. Now, the US will have a piece of legislation which they'll put to the floor as soon as Trump is inaugurated next year. That piece of legislation is called the Bitcoin Strategic Reserve. They will take existing gold reserves and they will revalue it up. They will use that to pay down the debt, and they will actually start buying some Bitcoin to back their currency with. So if this was sort of what you heard from Bitcoiners 4 years ago and you laughed and derided them for doing that, they were right, and I would say they were right faster than even they would have thought possible. So it's not a done deal, but the fact that this is now being talked about and will actually be up for debate in the US within the next 6 months, I think is fascinating and also speaks to the way things are dramatically accelerating. The US needs to do this in order to bring down those debt to GDP levels. So, moving on to the opportunity. We are witnessing the birth of an asset class, the greatest asset class in history, the fastest growing asset class in history. The intersection of AI and blockchain isn't just a transformation, it is a gift that we've been given. And it's going to redefine how we create, store, and transfer value. The whole meta of tokenization, real-world assets moving on-chain isn't a meme, it's a reality. It starts with the easiest products to move on-chain, and they will become more and more complex. Stocks, real estate, private markets are all going to go on-chain. And so the underlying infrastructure, the blockchains themselves, are being priced for future growth. Now, I do a lot of work for Real Vision where I look at on-chain data and use that on-chain data to give the subscribers a better sense of where we're headed. On-chain data is not perfect. It's not like an elixir or a magic bullet for prediction about the asset class, but it tells you the key information about the network growth, how much a blockchain is being used, right? There's an underlying theory behind how you value blockchain assets based on network theory or Metcalfe's law, that the value of a network is proportional to the number of users and interconnections on that network. So clearly, more people are using blockchains, more valuable they are. The on-chain data that you're seeing on the chart here is looking at the next 10 years in terms of growth. Now, I would normally put one of these metrics on a chart and do it in a logarithmic fashion so you can see that growth, because when you do it like this, it looks like, we haven't seen much growth in the last 10 years. It's been exponential, but it is going to continue. And so when you look 10 years out, you get some pretty amazing numbers. Now, daily active addresses, and an address is not a person, but it is a proxy for a person, currently using blockchains today is about 20 million, right? It was only 5 million a year ago. So it's more than tripled since then. Now, that sort of growth will slow to some degree, but the growth that we've seen, these cumulative growth rates, have happened without even AI, right? So when AI comes along and starts to do more transactions than humans ever will, when there's 8 billion AI agents or proxies on chain, and there's maybe 200,000, or in fact, they're a proxy for a human, you can see that the valuation of these assets is going to explode. Now, this is a model that I produced for the Real Vision community. Everyone, I think, is hyper-focused on this cycle. When am I going to take profits? When am I going to take profits? I missed out last time. The 2021 high was much lower than what the analysts had predicted. Therefore, I'm not going to be the idiot this time. I'm going to take profits. And I am not discouraging anyone from not taking profits this cycle. I will be taking profits at the right time. But I also think it's important just to understand that the adoption curve for this asset class is such that it is going a lot higher over the next 5 to 10 years. And as a strategy, I want to make sure that I'm exposed to that asset class as much as I can. So maybe we get to sort of from 3 trillion today to 30 trillion by somewhere in 2030, 2031. Don't hold me to it. It's going to be wrong. All predictions are wrong. But as long as the direction is right and the time frame for the prediction is more or less close, then at these sort of growth rates, we're going to see better opportunities in this asset class than most other asset classes, especially when you consider those asset classes are going to need blockchains to be able to settle, to move. And therein lies the opportunity. One last slide, because my time is up. This is the sort of stuff that we produce for the Real Vision community. There are deep dives. There isn't, it's not the kind of research where we're going to get into the nitty-gritties of one DeFi protocol versus the other for yield farming. We're trying to keep people's focus and attention on the bigger picture. What to allocate to, how much you should allocate, and thinking about when the cycles will end so you can position size and apply the right risk management. The last thing I just want to leave you with in terms of an idea is that most of the value in blockchains today are captured by the infrastructure layer, the blockchains themselves. If you add up Bitcoin, Ethereum, and all the other smart contract platforms, they account for at least 95% of the total market cap. Now, when you look at every other industry, the infrastructure layer usually does well at the beginning, but eventually that value accrues at the application level. Applications at the moment account for a very small percent of that total market cap, but there are, as you can see on the left-hand side, I've actually ranked a bunch of DeFi protocols as well as blockchains. And if you just look at the way that they're priced at the moment, some of these DeFi protocols are priced on less than 10 times the amount of fees, daily fees they bring in, whereas blockchains are actually trading on hundreds or thousands of times their fees. So, not a recommendation on a specific protocol, it's more like a way to think about investing in the space. It has actually not been a very good strategy to buy applications. It's been better to buy the big blockchains. But I think over time, maybe we don't see it even in this cycle. But one cycle from now, 2 cycles from now, a lot of value is going to accrue to the applications. So it's an area to keep an eye out on. I am now out of time, so I won't go through this slide. I hope you found it useful. By the way, Real Vision have an event going on in the networking lounge just after this. There's going to be a wine tasting. Feel free to drop by if you'd like and ask any questions. And I hope this is helpful. Have a great conference, everybody. I'll see you soon. Bye.